Okay, the target is based simply on objective factors. Okay, the target of your strategy is dependent on the strategy idea itself. Right, now, I know, just give me a moment. I'm going to get to a couple of examples and you'll understand exactly what I'm getting to with regards to this. Okay, now, the one way I like to think of, and 3 examples I'm going to show you before I go to the next slide. I'm going to show you 3 strategies that I execute day in, day out across all markets. Okay, the first one's called Trend Exhaustion Candles, the second one Breakouts, and the third one Trend Continuation Trade. Okay, so 3 different strategies, and I'm going to show you exactly the target for each one. The precise target based off of objective information. Okay, that's the key. Every single trade strategy has got a specific target based off of the principles of that strategy. Now, before I get to that, I need you to understand something very crucial. I mentioned this earlier in the first topic where we were talking about probabilities. Okay? One way to think about targets is like this. What is the most number of ticks or prices or dollars that you can take out of that trade strategy with the highest probability of succeeding? In other words, what's the highest probability that you can take the most number of ticks out of the market? Find that point, and that's where you want to exit the trade. And the best way to understand that is with this image. Okay? If you were to draw on the y-axis the rate of success or the probability of succeeding and the size of the target. Okay? For example, if I had a trade strategy that had a 10 price target, it would have a rate of success of 85% of the time. In other words, 85% of the time, if I had a target of 10 ticks with my desirable stop, I would succeed in that trade. Okay, the moment I try and go for 20 prices, that probably drops down to 42%. And the moment I go to 40 prices, that drops down to 10%. Now, this is why I was saying to you earlier, it's very misleading to look at markets in terms of 1-to-1 or 2-to-1 or 3-to-1, because it's got nothing to do with 1-to-1, 2-to-1, 3-to-1. It's got to do with what is the probability that the market's actually going to give me that amount of prices. Okay, that's the real nuance in the art form, is you get out of a trade based off of the highest probability number of ticks you're going to get. Okay, now yes, you do factor the probability with ultimately the probability that, the size of the stop. In other words, risk reward does play a role, because if you're using a 100 tick stop and you're only taking 10 prices per profit, with an 85% hit rate, unfortunately, that's not going to work out in the long run. Okay, so yes, the risk reward does play a role, but ultimately, we set targets based off of the probability that we can actually get that number of ticks. Okay, so the target must make sense first and foremost in terms of how much stop we're using. But the second part is, what is that point or that kink in our probability curve where we see a sudden drop off? Okay, the moment you see that sudden drop off, that is your optimal target for execution. And this can be done very simply with a backtest. Okay, so you can go and backtest this. You can go and work out if I took a 10 tick, or if I took a 20 tick, or I took a 40 tick, or I took a 100 tick, what is the probability that I actually am going to succeed at that trade versus failing at that trade? Okay, so let's use a couple of examples. Trend exhaustion. I'll explain the basic premise of the trade idea for you. You're more than welcome to go and research these strategies, develop them for yourself. They're not very difficult in terms of interpretation. Trend exhaustion is simple. Okay, when a market is moving very one-directional in a trend-like move, when there is a very high volume, high volatility at the end of the move, okay, that signals effectively an exhaustion move. In other words, it's forcing the last bit of liquidity effectively out of the market. Okay, at that point, when we get that trend exhaustion, when we get that high volume surge on the final candle, we are looking to fade the move. Okay, and in terms of target, the target's very simple. We're looking for a base of the exhaustion candle. It's as simple as that. If you go back test that, by the way, you'll see some very interesting things. One word of caution: not every strategy is suitable for every personality. Okay, some people don't like fading markets. I know a number of professional traders that I've shown this to, and they look at me like I'm not keen on fading the market, and I get that. Right? The point is that a strategy is not about how you feel about it. It's all about metrics. It's all about numbers. It's all about the probability. It's all about, if you see some form of price directional bias, Can you find an application to that context that you can make money? If the answer is yes, guess what? You've got edge. You've got a profitable strategy that's got positive expectancy. Okay? The target in terms of this trade is the base of that first candle. Okay? Why? Because what typically happens with this trade strategy is that there's a number of people caught. There's still liquidity that wants to get out. So typically what you see is a lot of two-way trade. Okay, so in terms of making this trade profitable, what I found in a back test was executing a target in and around that final impulse candle is the highest probability of ticks you can take. Now, sure, and this is key, listen carefully. Sure, this market came all the way back down there. It traded all the way back down. But as a trader, I don't care. Because target setting is not about taking 100,000 ticks. That's the mistake traders make. It's not about making the maximum out of the direction that the market went in. It's making the maximum out of what the strategy offered you. And that's what this is all about. Okay, sure, every now and again, the market's going to offer 40 prices. 10% of the time, it's going to give you that 40 prices. The reality is, I'm not interested in low probability outcomes. I'm interested in high probability outcomes because that is repeatable. That's what puts money in my bank account. And that's what strategy development is all about. Probability, frequency. Okay, that's the first trade idea. The second trade idea is what we call a breakout trade. You should all know this. And hopefully by the end of today, you've all got a very good idea as to what parameter you should be using for a breakout strategy. Okay, so I'm not going to go through the premise of a breakout. I think you all understand how a breakout strategy works. High volume, one directional time framing, very much low volume areas, lack of overlap in terms of trade. It looks very much like this picture looks over here. Okay, that's a textbook breakout example. Now, in terms of a breakout, the principle we're looking for, okay, a breakout by definition means there's large time frame participants. In other words, there's big sellers coming in the market or there's big buyers entering the market. Now, principally, the thing that's going to stop that choo-choo train is if someone steps in to decide to start buying the market for whatever reason. We don't know why they buy it. We don't care why they buy it. But we can observe when they start to buy it. Okay, and we can observe when they start to buy it the moment we get rotation. Okay, so this is what rotation is. It's moving in the opposite direction. Now, for me as a trader, I don't want to see the market close above a rotational down candle. In other words, the moment we close above a previous candle, I am looking to exit the trade. That's my signal, my objective cue that says, Brannigan, there is a buyer in this market who's providing sufficient liquidity. I now want to exit the trade. Okay? At no point on the way down am I looking at this going, oh, should I get out? Oh, should I get out? Oh, should I get out? No. I'm waiting for an opposite candle to close above one of the down candles. And at that point, I'm now looking to exit the trade. It's objective because every single time I see the same pattern, I can capture it, I can go and look at it, and I can say to myself, is there a better way to exit this breakout trending move? Objective. Not based on risk reward, based on, number one, price directional bias. What's the highest probability number of ticks I can take out of the market? Based off of the analysis I've done, the highest probability number of ticks I can take is waiting for that close above. Okay. Now, I did look at this, make no mistake. I did look at this the other way around, which is to say, well, what happens if I try and bottom pick? And I try and bottom pick that point at which it's gone quite far and my turn. The reality is, sometimes the market goes far, sometimes it doesn't go so far, and sometimes it goes stupidly far. For me, I don't want to miss out on that big winner simply because I'm trying to be too clever. Okay, so that's what it's about. It's not about perfection. It's about highest probability number of ticks and where I can be objective. Okay, that's what target setting is all about. Third, trend continuation. Now, a lot of you will take this trade. It's very simple. I have a trend in the market. I'm not on that trend. I desperately want to get on that trend. Okay, this is an example from the pound from yesterday. Okay, if you were trading the pound, the GBP USD, this is from yesterday. This is I think it's a 30-minute candle. Okay, so there's our trend move. Okay, very one directional, lots of low volume areas, lots of selling coming into the market. Okay, now we get our bounce. And this is where we want to sell the market. We want to get onto this trend. We are passive in entry, so we're waiting for the market to come give us a fill. Now, a lot of traders will look and say, well, you know, I want to take this all the way down to 125 because that's previous support and I want a 3-to-1. Rubbish. Okay, trend continuation moves from a probabilistic perspective. The highest probability number ticks you can take is a retest of the previous day's extreme. The highest probability. Okay, I'd go a step further and say if you go do the analysis of how often we get what we call trend day. In other words, 2 trending days in a row. It works out, it obviously depends on the market, but it's somewhere between the range of 2 to 5% of the time you'll get a trend day. In other words, it very rarely happens. It never happens. So why would you bet on it happening? Why would you bet on the outlier that infrequently happens? Bet on the highest probability outcome. Okay, I know for a high degree of certainty that I can get out for my profits on a retest of the previous day's extreme. I know that with a high degree of certainty. Now, sure, sometimes it keeps going and I look at it and go, cool, well done if you stayed on the trade. I'm very happy for you. But I'll keep repeating this trade and I'll keep making money of it with a high degree of probability and a high degree of certainty. Moreover, when I go and analyze, when I go and capture my trades and I annotate my charts, I've got an iterative process that I can keep evolving because I've got objective data to lean on. Okay, and that's where all of this gets to. When you start to capture your trades, okay, this is straight from the Tradelo application. When you capture 10 charts of the same strategy, 20 charts, 30 charts, 40 charts, you are going to become a master of pattern recall. Moreover, you're going to be so good at understanding what is the perfect way to enter your trade off of probability. What is the perfect stop to use off of iteration? And what is that perfect target that you know you can capture more often than not? But it only comes through iteration. I cannot stress that enough. There is no quick, easy fix to developing the skill of pattern recall. It simply comes through executing the same strategy over and over and over again. That is the truth of the matter. Okay? And where does all this get to? Where do we get to when we iterate? Now, at some point, obviously, for some of the newer traders at Tradelo, you wouldn't have experienced this yet. For some of the more senior traders at Tradelo, this is where you get to. Okay, this is where your application says to you, look, that trade, open drive that you've got in the S&P 500, well, guess what? Your target on that is 18 to 21 prices. In other words, when you've got sufficient amount of data and you've mastered your trade strategy, the system's telling you more or less where you should be targeting. Now, that acts as a double sort of benefit. Number one, it means when you're 5 prices inside, you're not sat there concerned about the trade coming back. Okay? And that's the key thing I see with a lot of traders. They're so emotional, so afraid that a trade comes back. If I told you 90% of the time your trade's going to give you at least 18 prices, you are not going to have any emotional energy assigned to that market coming back in your face. Okay? You're not going to be afraid. You're just going to sit there with an objective mindset. That's the real key, and that's the power of data. It enables you to make optimal trading decisions.